Welcome to the Deep Dive, your compass for navigating complex topics. Today, we're plunging into, well, a really interesting area: Thai property tax advantages, myth or reality. It's a question that, honestly, anyone even thinking about real estate in Thailand needs to ask. Our guide for this is a really insightful article, same title, written by Agel Ovide Etienne and published by Ocean Worldwide. Now, many of you will know Ocean Worldwide. They're a top-tier luxury real estate agency, been based in Phuket since way back in 2004. Their director, Sandra O'Neill, has personally helped, well, thousands of families and investors over the years, focusing on that high-end market in Phuket and Koh Samui. So our mission today: let's cut through the noise, challenge some common ideas, and give you clear, actionable insights on Thai property tax for foreign owners. Okay, let's unpack this.
Yeah, it's a really essential topic right now. Thailand's property tax system. It's seen some pretty major shifts recently. What used to be, let's say, a bit more lax has definitely evolved. So understanding the current rules is absolutely crucial if you're considering investing. Doesn't matter if it's a holiday villa or something bigger. It can definitely feel like, well, a minefield if you're not up to speed. So hopefully we can clear that path a bit today.
Absolutely. So let's start right there, understanding this evolving landscape, because, everything really changed with the Land and Building Tax Act in 2019, didn't it? What was this sort of fundamental shift there?
The core change really was moving away from older laws that mostly focused on rental income. This new act, the Land and Building Tax Act from 2019, it taxes property based on actual ownership and how it's used. It's designated use. So this means even if you own, say, a beautiful holiday home down in Phuket, and maybe it sits empty for half the year, you're still liable for an annual tax. The overall aim, so modernize the system, push more productive land use, and kind of spread the tax burden more fairly.
That sounds like a really significant shift. And for foreign owners specifically, how does that big restriction, not being able to own land directly, how does that factor into this new tax picture?
Yeah, that restriction is a huge consideration. Foreigners, generally speaking, cannot own land outright in Thailand. Simple as that. So this often pushes foreign investors towards using Thai company structures to hold the property. And while that's a common approach, it definitely adds layers of corporate complexity. You're not just thinking about property tax then, you've got the whole corporate tax framework to navigate as well. So for instance, if you own a lovely, say, 4-bedroom luxury villa in Cherntale, Phuket, through a Thai company, you need really careful attention paid to both sets of rules, corporate and property.
Wow. Yeah, I can see how that gets complicated fast. So what are some of the biggest myths, maybe misconceptions that are floating around about Thai property tax? Things we need to debunk right now.
Well, a big one, a really pervasive myth, is that just owning property through a Thai company somehow magically makes you tax exempt. It's just flat out wrong. You're still liable. The tax obligation just runs through the company structure. Another common one is thinking owner-occupied homes are completely exempt under the new act. Also not true. The reality is the tax rates vary quite a bit, and it's all based on the property's use, how it's classified. So you've got agricultural land, rates up to 0.15%, then residential properties, up to 0.30%. But commercial properties, and importantly, unused or undeveloped land, they face much higher rates, potentially up to 1.20%.
Okay, so that classification is key.
Absolutely critical. The strategic insight here is that your intended use really dictates your tax burden. What looks like a small percentage difference on paper, say between residential and commercial, over years that can mean massive savings or costs. It fundamentally changes your ROI. So getting that classification right from day one is vital to avoid nasty surprises down the line. Penalties, back taxes, you name it.
That really clarifies the basics. So, okay, once you own the property, what are the sort of ongoing financial realities? Let's talk annual tax responsibilities. What does every owner face?
Right. So every year, property owners have the land and building tax. It's assessed based on the official value of the land and any buildings on it. It's a recurring thing, an annual obligation. And it's important to know that the exact timing for assessment and payment deadlines, they can actually vary a little bit depending on the local municipality where your property actually is. So, being proactive, knowing those local deadlines, that's key to avoid penalties.
And how much does the way you use the property, the utilization, really impact those tax rates? Is it a big difference if you live there versus, say, renting it out as a guest house?
Oh, absolutely. A huge difference. How you utilize your property directly impacts the tax bill, massively. A property used as your primary residence, for example, might qualify for a lower rate or certain exemptions compared to, say, a commercial building or a guest house, or even that luxury villa you're renting out for income. Take, for instance, a nice plot of land in Kamala, Phuket. The tax implications will be completely different if you plan to build your family home versus developing a small commercial resort. I remember one client actually, they overlooked their guest house properly. They just assumed residential.
Oh, dear.
Yeah, the back taxes and penalties. It was a very, very painful lesson in why getting that property use classification correct matters so much.
Yeah.
Which brings us back to records. Keeping all your property records organized is crucial. You need to be able to easily prove the property's use come tax time.
Makes sense. Now, for many people, the big appeal of Thai property is the income potential, right? Especially with luxury rentals. So if you are generating rent, what are the tax implications you absolutely must know?
Okay, so if you're a non-resident foreigner and you're earning rental income from your Thai property, there's typically a 15% withholding tax applied at source. But, and this is important, the 15% isn't necessarily the final amount you'll pay. Once you factor in allowable deductions and consider your overall tax situation, especially if you own it personally, your actual taxable amount could be lower, significantly lower sometimes.
Okay, deductions. What are some of those key deductions that can help bring down that taxable income figure?
Well, you can typically claim standard operating expenses, things like repairs, ongoing maintenance costs, fees you pay to a property management company if you use one. But beyond those day-to-day costs, probably the biggest lever for reducing taxable rental income is depreciation. The depreciation of the property itself. Think of it as, the government recognizing the wear and tear on your building over time. It allows you to legally reduce your taxable income quite substantially. But you can't just claim it without proof. Meticulous, proactive record keeping from day one is essential. Without proper documents, it's like trying to claim a warranty without a receipt. It just won't fly.
Got it. So meticulous records are non-negotiable. Are there any sort of clever strategies for mitigating the tax burden on rental yields, especially for owners of those high-end luxury properties?
Yes, there are things to consider. One effective tactic can be to split your rental income stream. So instead of just charging one lump sum for rent, you could structure the agreement to charge separately for the actual property and then separately for other elements like furniture, maybe utilities, or other services provided. Why do this? Well, the income you get from the furniture and services might be taxed differently. Sometimes it might even be exempt from certain property taxes, especially if you're not VAT registered.
Ah, interesting. But there's a catch.
There's always a catch, right? If your company is VAT registered, then you absolutely have to charge 7% VAT on that furniture and service income. The government basically says, look, you're providing a taxable service with those extras. So that 7% eats into your profit margin on those items.
Okay.
It's a detail, but it can make a real difference to your bottom line, especially if you have, say, a luxurious pool villa in Phuket pulling in significant rental income. Getting professional advice to structure this optimally is really key.
Okay, so we've covered the ongoing taxes, the rental income side. Let's pivot to what happens when you decide to sell. What kind of property transfer taxes and fees should sellers brace themselves for?
Right, the exit strategy. When you sell, first there's a withholding tax on property sales. Now, if the seller is a company, it's usually a flat 1% of the registered sale price or the government's appraised value, whichever one is higher. If the seller is an individual, it's calculated using progressive tax rates based on the profit made. So it depends on how long you've held it and how much gain there is. Getting this withholding tax calculation right is vital, particularly for, a high-value asset like a luxury villa in Phuket. Then you've got something called specific business tax, or SBT.
SBT, what triggers that?
Think of SBT as a tax aimed at curbing short-term speculation, or flipping. It also applies if the sale is considered part of a business operation. It's charged at 3.3% if you've owned the property for less than 5 years. The small silver lining is that if you do pay SBT, you typically don't have to pay stamp duty as well.
Okay, so it's one or the other, usually. What about the standard transfer fees and that stamp duty you mentioned?
Yep. The standard transfer fee itself is 2% of the property's appraised value. How this is split is often negotiable between buyer and seller in a private sale.
Often 50-50.
Often, yeah, but not always fixed. However, stamp duty is 0.5% of the appraised value. And as I said, it's usually waived if SBT applies. One specific point. For brand new condos or houses bought directly from a developer, the law often mandates that the 2% transfer fee is split 50-50. These costs definitely add up, so you need to factor them into your sale calculations.
Right. Beyond these property-specific taxes at the point of sale, what about ongoing personal income tax for property owners, particularly where foreign nationals living outside Thailand?
Okay, so if you own property directly in your own name, not through a company, and it generates income like rent, You're generally required to file a Thai personal income tax return. The deadline is usually the end of March each year, and you report your income and your deductible expenses. Thailand uses a progressive tax system. Rates go from 5% up to 35%, depending on the income bracket. But again, you can significantly lower your taxable income by claiming those allowable deductions, repairs, management fees, crucially, depreciation.
And records again?
Records again, absolutely essential. The structure matters too, of course. Direct ownership versus using a Thai company impacts how these personal tax obligations work or if they apply directly to you versus the company. And for that beautiful luxury villa in Phuket generating good income, again, exploring how you might legally split income categories. The building versus furniture and services could offer tax benefits, but, you need very careful structuring and professional advice.
Okay, crystal clear on the tax side. Now, let's really tackle that big issue for many potential buyers, the foreign ownership restrictions. Can foreigners actually own land outright in Thailand? Let's just get the straight answer.
Straight answer is generally no.
Yeah.
Foreigners cannot directly own freehold land in Thailand. The Land Code Act is very clear on this. You can't just, buy a plot of land in your own name and hold the title deed directly like you might in, say, the U.S. or U.K. Now, there's some very specific exceptions, perhaps through the Board of Investment, the BOI, regulations. But these usually involve huge investments, very strict conditions. Honestly, they're impractical for most individual buyers just looking for a home or a standard investment property.
So if direct freehold ownership is pretty much off the table for most, how does that common method work securing freehold through a Thai company? And what are the real risks there, especially now?
Right. Historically, setting up a Thai company, where Thais hold the majority of shares, was the go-to method for foreigners wanting indirect control over freehold land. But this area has become, well, let's say, significantly more scrutinized. It's a bit of a minefield now. The Thai government has been actively cracking down on what they call nominee structures.
Nominee structures.
Yeah, basically companies set up purely as a front, where the Thai shareholders are nominees, holding shares for the foreigner, but the real control and financial benefit rests entirely with the foreign investor. And crucially, there's no legitimate underlying business activity. So, take that amazing luxury villa in Phuket with stunning sea views owned by Thai Company Ltd. That company must be a genuine operating business. It needs proper accounting, yearly shareholder meetings, maybe demonstrable business activity, not just exist on paper solely to hold the land for the foreigner.
And the risk if it's deemed a nominee.
Big risks. Serious legal challenges to your ownership structure, potentially fines, and in the worst case, you could effectively lose control of the property and your investment. It's not something to take lightly at all.
Wow. Okay. So given all these complexities, the taxes, the ownership structures, the regulations, what are some practical ways people can start thinking about optimizing their tax efficiency? What's fascinating here is...
Well, a key part of tax planning is really thinking ahead,
Mhm.
right from the start. How should you structure the ownership? Personal name, Thai company. The decision should be based on a clear understanding of the tax implications for both the income you expect to generate, like rental income, and also for the eventual sale down the line. And it's definitely not a one-size-fits-all answer. It really depends on your specific goals, the type of property. Is it a luxury condo in Phuket or maybe a beachfront villa over in Koh Samui? Each scenario might favor a different approach. And just to circle back to an earlier point, because it's a common strategy,
Yeah.
splitting those rental income categories, separating income from the building itself versus income from furniture and services.
Right. The furniture services split.
Exactly. It can be a clever tactic for potentially reducing the overall tax bite, but always remember that crucial point about VAT. If the company is VAT registered, you're adding 7% VAT onto that furniture service income. So you need to weigh the benefits against that VAT cost. This kind of detailed planning can really impact your net return, so again, exploring it with an expert advisor is usually worthwhile.
It really sounds like trying to navigate this alone is just asking for trouble. Which brings us neatly to the role of professional advice. How indispensable is it, really?
Honestly. In this context, I'd say it's pretty much indispensable. Consulting a good, qualified tax advisor or lawyer who genuinely understands the intricacies of the Thai system, it's not just an expense, it's truly an investment. They can help you identify legitimate ways to save tax, structure things correctly from the outset, and perhaps most importantly, help you avoid making costly mistakes. Mistakes that could far, far outweigh the cost of their fees.
And finding the right advisor is key, I imagine.
Absolutely. This is where firms like Ocean Worldwide, who are deeply embedded in the luxury market in places like Phuket and Koh Samui, can be invaluable. They're not just facilitating a sale, They understand the whole financial ecosystem around it. Good advisors can give specific guidance tailored to your situation. Clarifying tax rates for different property uses, making sure you hit deadlines, helping you navigate new developments or interpretations of the law. And they will hammer home the importance of that meticulous record keeping for deductions. When you're choosing consultants, look for firms or individuals with a solid track record, especially working with foreign clients, and find someone who can explain complex things clearly in plain English.
Makes sense.
The benefits are huge. Understanding your tax exposure, getting paperwork right, maximizing legitimate expense claims, staying compliant with evolving laws, and ultimately, just having peace of mind. You really need to view their fees as part of the investment required to protect your main property investment.
Definitely sounds like wise counsel. And finally, given how things seem to change, how can listeners make sure they stay informed on these regulations and maybe recap some common challenges they face?
Well, beyond just the complexity of the laws themselves, a major challenge for foreign owners is simply navigating the system. The potential for quite hefty fines or even serious issues with their asset if things aren't done correctly is real. And let's not forget the language barrier. Official documents, tax forms, they're all in Thai. Trying to decipher those without fluent language skills is incredibly difficult and risky. This unfamiliarity can make even straightforward processes feel really daunting.
So, strategies to overcome that.
Number one, as we've said, get professional help. Good legal and tax experts who specialize in Thai property for foreigners, they bridge that knowledge and language gap. Number two, maintain those meticulous records. It's your shield, your proof. Think of it like a detailed diary for your property. Every bet spent, every communication received, every contract signed. For a high-value asset like an exclusive beachfront villa in Koh Samui or a luxury resort near Phuket, this isn't optional, it's essential. As for staying informed, subscribing to newsletters from reputable Thai law firms or established tax advisory companies is a great start. They often summarize key changes. Attending seminars or webinars, when available, can also provide timely updates straight from the experts. And sometimes, believe it or not, well-moderated expat forums can surface practical questions and answers, though always verify information from official sources.
And remember, it's evolving.
Exactly. Thailand's tax system isn't set in stone. The 2019 Land and Building Tax Act was a huge shift, moving the focus from just income to actual ownership and use. Remembering that the rates for agricultural land are vastly different from residential, which are different again from commercial or unused land, that understanding is fundamental now. So yeah, proactive record keeping for absolutely everything, transactions, income, expenses remains your best strategy in this dynamic environment.
That's incredibly helpful. So let's circle all the way back to where we started, our big question. Are Thai property tax advantages real? Myth or reality? What's the final verdict?
Well, like most things in life, it's not a simple yes or no. It's more nuanced than that. While the newer Land and Building Tax Act does aim for fairness, and yes, it generally offers lower rates for residential properties compared to commercial ones, which could be seen as an advantage. Foreign owners absolutely must be aware of the income tax implications on rental earnings, plus all the various transfer fees, SPT, stamp duty, and ongoing obligations. So it's definitely not some kind of tax haven or a free-for-all where you can expect massive breaks just by buying property. That's the myth part. However, and this is the reality part with diligent planning, that crucial, meticulous record keeping and crucially, getting advice from experienced local tax experts, especially advisors familiar with the specific markets, like the luxury specialists at Ocean Worldwide in Phuket and Koh Samui. Then yes, your tax obligations can certainly be managed effectively. They don't have to be overly burdensome. So the key takeaway, stay informed, be proactive, get good advice and manage it properly. It's manageable, but requires effort.
That brings fantastic clarity to what can seem like a very murky topic, thank you. And it leaves us all with maybe a final thought to chew on. Given this constantly evolving nature of global property markets and digging into the specifics like we have today for Thailand, how might understanding these kinds of granular tax nuances in one country actually inform your approach to any international investment you might consider, even if it's completely outside of real estate? Something to think about until our next deep dive.